Well, good afternoon, everybody. Welcome back to another episode of the Industrial Real Estate Show. I'm pleased to be joined by a friend of mine who's been a guest on this channel before and is an industrial real estate investor in OKC and I think other markets as well. We'll jump into all of that. But first of all, Deren Huang, thanks so much for joining me on the show again.
Yeah, thanks for having me. Really excited to be here. I actually am in Tulsa, not OKC, but yeah,
Oh, I thought you were in OKC for some reason.
I'm with Hunt and Zach. They're both here in Tulsa, but obviously they invest all over. I just invest here in Tulsa. So yeah,
Just
I'm
Tulsa.
excited to be here though.
Are you an OKC fan for basketball?
I am an OKC fan, so I'm rooting for them currently. We are in the finals, so hopefully it shakes out and we do really well.
Well, I'm hoping for OKC as well. It's been an exciting. What I really love about the finals, not to get too off on a tangent, is that both teams haven't really won anything in a long time. So no matter who wins, it is going to be a party in that city.
Yep. Totally. I relate a lot to our GM who has rebuilt the team. And so I see a lot of value add and he does a lot of deals. He's a deal maker. So he's turned we have so many draft picks and it's just crazy. So it'll be interesting to see how he does this and what the plans are. So yeah.
Oh, it's a be exciting. You wanted to start off with a lightning round idea, and I love it. I'm
Yes.
all for it. You can take it away.
Yep. So I watch a little bit of short form content, especially around basketball and different things like that. So we are going to have Chad blindly rank some of these investments without knowing what comes next. So it's 1 through 5. I was kind to you, Chad, so I didn't throw so many curveballs at the end. But I think you'll enjoy this. So just a little bit lighthearted fun before we jump into the interview. So Chad is going to rank these investments 1 through 5 without knowing what comes next. So the first one, gold.
I'd say a 3. It goes in such waves that if you catch it at the right time, I think you can have a really big lift. If you catch it at the wrong time, it can be flat for a long time. So I think it's a good hedge. I think I've got some gold, but I wouldn't put all my eggs in that proverbial basket.
Yep. So right down the middle. All right. Next one, Bitcoin.
Same thing. I like Bitcoin. I have some Bitcoin.
Mm.
I think it'd be crazy not to own a little bit of Bitcoin just because it does have the potential to go crazy. I think what people underestimate is it also has the potential to go to zero. And I think a lot of people would probably argue with me on that and say that there's always going to be that store of value. But I think it to some extent it's a modernized version of gold.
Where did you rank that one?
3.
1 through 5. 3. Oh no, sorry. You have to rank them
Oh, it's all
1 through 5. Yeah.
okay. Well, I'll give that one a 2 then.
Oh, above gold. Interesting. This one is a shout out for you. This is the curveball. It is a 1959 Gibson Les Paul Burst.
I'd give that I'd put that at the bottom actually. I have a few.
Oh,
Yeah,
interesting.
I have a few Les Pauls. I have a 58 reissue, and they don't hold their value. I suppose if you got
Really?
something very rare, maybe it would. Uh, but yeah, the collector market is very small and it's aging. Most of the people that go
You are
towards
correct.
Gibson and Les Pauls, they're getting older, so that new market of potential buyers is seems to be dwindling. I've been trying to sell a Les Paul custom for a while, and it's I've had zero activity on it.
Wow, I would have thought that would have been number one for you, but I think this one will take number one, the S&P 500.
One, yeah, one for sure. If,
Yep.
if I could go back and do it all over again, all I would have done is dollar cost average into the S&P from day one. As soon as I had my first investable dollar, that's all I would have done is plug money into the S&P. Number one.
All right, and then last but not least, this one is at number 4, the U.S. Treasury bond.
Yeah, good safe asset. I suppose depending on where you're at in life, I guess I have to put that one at 4. I think that's a good safe asset. I think if you're want to have that consistent, stable income without the risk of downside, then I think that's a great asset. I think the older you get, probably the more you should be putting your wealth into bonds. So yeah, good asset. If I could go and do that all over again, I probably would have actually put that one too. But slides in the
Interesting.
4 behind Bitcoin and gold.
All right. Well, I am shocked. I thought that the Les Paul would have taken it at number one. But really, realistically, you are just too analytical. So S&P has to win it all. All
Yeah,
right. You
and
ready for the next
anecdotally,
round, Chad?
yeah, anecdotally, I just have a Les Paul that I can't sell. So that's why that was just bad experience on my end. There's probably some investors out there that think I'm crazy for that, but yeah, it's just my own experience. Okay, next round.
All right, next round. This one is a little bit more general. So this is asset classes. Just because we are industrial nerds, I have left off industrial. So just as a FYI. So the first one, Chad is going to rank these investments 1 through 5 without knowing what comes next. Residential multifamily.
It's going to be area specific, I think. So I've got to account for that with this being a very broad question because I think there's some markets that could struggle where there's some that are going to do quite well. But I think multifamily is going to be a 3. I think that one's a good,
Oh, right down
safe
the middle.
investment. The one thing that I really like about multifamily is that you're diversifying across several doors, as they say in that market. And as long as you're willing to adjust your rent $50 or $100 or $200, as long as you're willing to lower that incrementally if you have to, you should always have tenants available if you're in a good market in a good area. So I like multifamily. It's not for me personally, but I know a lot of people have done really well in it.
All right. Second one is office.
Yeah, that's another tough one. Are we talking Class A, a new Class A building or a Class C building? Because that's a huge difference between the two. I I I don't mind office right now. I think that there is going to be a resurgence of back to the office mandates that still could take a while. That could still be a 5-10 year trend. I don't think the pricing fully reflects that risk of how long it could take. So I'm going to slot office in at 4.
Ooh, okay. Retail.
Retail, I like. I'd put it as a 2. It's as long as you're
Two.
getting a good property in a good market. I think that there's always going to be tenants, even though that there's been a lot of movement towards e-commerce and that's been well studied. There's still so many retail opportunities that's experiential, or you got to go. You can't have your teeth cleaned online. You have to go to a dentist, and a lot of those are in retail centers. So I think that there's always going to be demand for good quality retail too.
All right. Residential single family
I
SFRs.
I'm gonna slot that in at 5. It's
Oh.
there's and that might sound a little different from the multifamily, but with single family homes, and you know this as well as I do, the returns are really poor. So you're basically betting on strict appreciation in the market. So that you buy a house at 500 grand, you hope you can sell it at 750 down the road. And if you have no cash flow, in some situations, you might even have negative cash flow in a single family house. The returns are just really poor. I think unless you can do it at such a scale like a BlackRock who's buying up everything, I think the average investor would be better suited looking at other options.
All right. Well, number one, I don't think you'll be happy with this, but I put agricultural land.
Yeah, okay, well, number one is agriculture. As long as it's income producing. So here's an angle that I would make in favor of, and I've got to put my hat on here now that I've
Yeah,
had
yeah.
this one number one. I could easily poke holes in this, but I think if you're buying agricultural land in the path of development and you've got income coming in there, whether you're renting it to a farmer or whatever it is, if you're the path of development, you're land banking. So getting paid to hold that land in the path of development. I know some people in our market who were very unsavvy. They're not even investors. They just bought a quarter section 20 years ago, and the city expanded far enough. One in particular just had a $20 million offer on a property that they bought
Oh,
200 grand. But it's right in the path of residential development. So yeah, agriculture, number one, number one, baby.
what would you change? So you had ag land at 1, retail at 2, residential multifamily 3, office 4, and then 5. If you were to actually rank them,
I
would you
would,
change it up a little bit?
yeah, being the devil's advocate, I'd probably put agriculture at the bottom. So I'd move everything up one spot and bump agriculture to the bottom. It's you're playing in a big game there. Like if you could find a quarter section for 200 grand now and it's in the path of development, you'd be obviously a genius. But
Yeah.
anything that's in the obvious path of development right now, you're paying already a premium. So and it's just not for me. I don't want to be dealing
Yeah.
with all that, and it's just not my area specialty. But for sure that there's people that have made a killing on it. But yeah, I like all the other ones better.
Yep, me too. All right, very last one. This one's a little silly. We have specialty use, and from the get-go, I think you'll like this one. So this is a little silly. So first up, a McDonald's ground lease.
And we're one to
Where do you
five
rank
again.
that?
I'm
And you
gonna
don't know what's coming next. This one's a
uh,
little silly.
I'm gonna put that one at a four.
Ooh, okay.
I'm a value add investor myself. Everything that I've bought has been either with leases coming up or the ability to add some value. So even a vacant space. And I'm not a coupon clipper where I want to buy a property that has a fixed return for 10 or 15 years. That's just, there are people that want to do that. That's more on the bond side. I'm more on the risk side where I'm willing to take some risk, and you're not taking a lot of risk with just a triple net ground lease. So it's good. I mean, if you can get a good return on it, and you can maybe, I don't even know what those are getting pushed down to right now. Like, is that a five cap? Is that a four cap? Like, I don't even.
No, it's smaller probably. So the second one, you're at four for McDonald's ground lease. Olive Garden for the next one.
Five. McDonald's would probably be a
Oh wow.
better,
You don't
better.
like breadsticks and
Oh, I,
endless
I
soup?
I love the endless breadsticks. Too much, actually. That's why I have to put that one in the five. If I was investing in it, I'd be eating endless breadsticks every day. So I definitely have to put that one as a five.
Okay. This one and the next one. So McDonald's ground lease four, Olive Garden five, a golf course.
Six. So, if I have to if I have to stay true to the rules, then that's a three. Uh,
That's the three.
I think a golf course is the textbook trophy asset. I think that guys go to buy it so they can brag to their friends that they own a golf course. And I think they're terrible returns. I've seen so many go into receivership, numerous. And more, I've seen more golf courses go into receivership than I've eaten breadsticks at the endless Olive Garden. That's so, yeah.
That's the ranking right
Yeah.
there. All right. Two more left. So the second to last one, pickleball restaurant concept.
Two. It's
Two. Okay.
I've been involved in a few pickleball deals now, and I think
Okay.
pickleball is definitely here to stay. Like that, I was one
Yep.
of the skeptics early on, but it is here to stay. It People have so much fun with it that it's crazy actually. So it's here to stay. But I think that it's way oversaturated right now. I think everybody
Mm.
saw this as the next gold rush. You going back to the earlier example, and it's the pickleball rush. I think there's going to be a ton of these that fail. So yep, two only because
All
I
right.
bought it in there.
Last but not least, this one's funny. A drive-through wedding chapel.
I
That is
try.
your number one spot.
That's my number one. Well, I guess I have to be an advocate for that one again. So the case is that we've got a new generation of people coming in that are all looking for very quick service. Where Amazon 2 hour delivery times, where Amazon, if you get something 2 days from Amazon now, you feel like it's slow. So we're in this culture now of people wanting things quick. Why have to book out a venue a year down the road and have to do it when you can just drive up? I mean, I could be a pitchman for that. I could be the guy
Yep.
on the late night infomercials. So yeah, number one.
Number one spot. Obviously, if you were to change it, you have drive-through wedding chapel, pickleball restaurant concept, golf course, McDonald's ground lease, and Olive Garden. How would you change it up?
I would flip it completely. I'd
Oh,
So the golf course would stay three. Maybe I'd rotate the McDonald's for the Olive Garden. So McDonald's would be the number one out of all those.
mm.
I like risk, but the pickleball concept and the drive-through wedding chapel seem to be a risk that I would need such a high return on that it wouldn't be viable. It wouldn't pencil, as they say.
Yeah. No, that's funny. Well, that's all I had. I brainstormed some this morning, thinking to have a little bit of fun.
I love it. I always love having a little bit of a different take on it because sometimes podcasts can be a little dry. I always try to keep it just very conversational, and so I love it. And please keep doing that. Next podcast you go on, whether it's mine or someone else's, do that again. I think that's a ton of fun and good
Yeah.
clips to break down into smaller ones too.
Nice.
Let's talk industrial then. What's out
Yes.
of all those? Let's even combine all of them. You've got the S&P, you've got the bonds, you've got all the different asset classes,
Oh
you've got the
man.
riskier ones. Where do you put industrial? Where do you put industrial out of all 15 of those potential investments?
All the way at the top. That's where I'm putting most of my money, most of my capital. Obviously, the S&P is the benchmark. It's what you have to compete with. And so it would be silly for me to say just from a math standpoint that it's not a good investment. It's obviously a very, very good one, but I am full blown into industrial. And so I re-listened to the episode that we had in 2023. And at that time, I had still over 100 residential single families. That was one of the categories that we had. And then I only had about 100,000 square feet of industrial. Since then, what I've been doing with my portfolio is I've taken that 100 plus units. I think at our peak, we were like 107 or 112, somewhere around there. I've sold off to where we have about 60 left, and I'm going to continue to sell those off. Really kind of doing the 80-20 principle, taking the 20% that are headaches, getting rid of them, doing it another round. Hey, after 80 or 75, what's the next 20% that I want to take off? And then just keep on doing that iteratively until I have some of the best assets of those single families. And then since then, I've shifted my focus to the industrial side, all local kind of tenant, single, all infill industrial here in Tulsa. And now, since we last talked, it was 100,000. Now we have over 200,000 square feet. So we
Wow,
doubled our portfolio when it comes to the industrial side. So, if I was to rank it, obviously industrial first. There's different, and this is it's been interesting listening to the interviews that you've had, Chad. Is this that like industrial is such a huge word because it is the largest asset class. There's distribution, there's manufacturing, there's small bay, there's even iOS and stuff like that. And so right now we're really focused on infill here in Tulsa.
Yeah, great point on that. I think that's worth emphasizing is that it is, as you mentioned, a big word because it encompasses so much. And one analogy I always give is that it includes the 4 million square foot Boeing manufacturing facility in Everett, just outside of Seattle. And it includes a 2,000 square foot small industrial condo bay. All of that is included under the umbrella of industrial, but the dynamics of those two contrasting properties couldn't be more stark. It's almost a difference of talking a Olive Garden versus an automotive repair shop, right? Like they're just so different, but they all get grouped into that industrial. So are you, and some people might call what you're looking at Class B. Is that what you're mostly Class B infill industrial? So what does an average property that you'd target look like?
Yeah, so right now we've targeted a couple different areas here in Tulsa. It'd be interesting because, previously when we chatted in 2023, I was working through my second purchase and that was vacant. Since then, we've actually sold that one because it was on the market for 6 months and we couldn't get a tenant. So we positioned it to an owner occupant. Luckily, we got out unscathed and made a really good return just because of that market and just because of the industrial market. But yeah, we focus on what they call either shallow bay or Class B infill industrial. Usually, we do like a land component to it where we could do a fenced-in yard or there's room to expand. But yeah, that first. The second purchase that we talked about last time, about a couple of years ago, there were so many mistakes now that I know, looking back, even 2 years into this. Some of the mistakes include that you had to back into the bay doors through a busy street. So you had to go through a 4-lane highway to back in. The density is what I think you call it the site coverage ratio, was over 50%. So there wasn't really that much parking space or even land component. Now what we target is anywhere from 20 to 30% of that site coverage ratio, whereas iOS is usually like less than 10% or less than 15%. So we like the mix of both and kind of go from there. But yeah.
Yeah, it's crazy. And it's the same thing with me. The first property that I bought, actually, I still own that one. So the second property that I bought had issues as well, where I was like, I should have been able to identify these. So that's the one thing with industrial. And I caution any investor with this is that industrial should actually be scary for the first time investor because mistakes are magnified. Whereas if you make a mistake in multifamily or you make a mistake in other asset classes, you should be able to mitigate that I shouldn't say relatively easy. You should be able to mitigate it. Let's leave it at that. Whereas industrial, if you make a mistake and you get something that the market doesn't want to rent, you better hope that you have an exit at least to an owner user, because if there's not that exit, you can really lose your shirt on that. What other mistakes? You mentioned the drive lane access. Have you seen any other things that have now formed your buy box that would have been different 2 years ago?
Yeah, definitely. This one, what I was kind of chasing, which is really interesting, we kind of rank what is a functional warehouse. But really, I think there's a one of your podcast guests named Joel. He said, we really look for geometry. We don't look for triangles. We don't look for, weird corners. We really look for rectangles and boxes. But what I was chasing in that property was clear height because I heard, hey, all these users need clear height, et cetera, et cetera. And so this one had really great clear height, but it wasn't really geometric. And so I've now learned that, especially in infill properties where you're in the middle of town next to population, that the clear height is not necessarily, it is still very important, but it's not necessarily the most important thing. And so I said, hey, let's be on this side of town, but with clear height. But really, what matters most, and it kind of is cliche to say, but is the location. So we like being next to. There's a couple highways here in Tulsa. There's one that connects that goes kind of like a X shape. So we like being what I call in the armpit of those, and so access to either north and south, east and west very, very quickly. And we've identified a couple pockets there. But yeah, some of those mistakes include, hey, I thought that I could attract a tenant just with the characteristics of the building, for example, clear height or heavy power, and they wouldn't mind being on the opposite side of town because of this building. Whereas once again, for most companies, they really care about the location and of course the building too. But in some cases, they'll just make it work if it's instead of 24-foot clear, I have 20-foot clear or something along those lines.
Yeah, great point. I read a study a number of years ago, and I couldn't put a date on it, but I'm sure the information is still valid. When they looked at and this was more on the warehousing logistics side, when they looked at the company's P&L, the expenses for the major components, transportation was 50% and rent was around 5%. So it makes so much more economic sense for a company to focus on the location, like you mentioned, if they can trim down that transportation expense versus saving a little bit on the rent, but increase in transportation expenses. So I think the location key, although that is a cliche, the location, I think that is just applicable in industrial as it is in residential. What have you found for because companies are still going to take everything into account. That location is going to be a primary driver for sure, but there's still going to be a ceiling height requirement. There's still going to be that loading area requirement, still a power requirement. How do you look at those when you start getting more granular into your due diligence?
Yeah, once again, it's about the functionality. I'm stealing the phrase geometry from Joel. But if you're looking at a 2,000 square foot building and expecting to have 40-foot clear height, that's really not geometrically, think of a really tall cylinder. It's not really geometrically in line. And so when you're looking at smaller buildings like I am or infill, they might not need to have the 30-foot clear that, new builds and warehouses now are being built with. And I've even heard 40-foot clear now in some cases for some of those million square foot warehouses. But really, we look at the geometry. So, we can get away. For example, previously when we last chat, we were under contract for about 40,000 square feet. We since then purchased it. There's about 10,000 square feet that is low clear height, like 14 foot, but they're only 1,500 square foot bays. So for what we call right out of the garage or contractor space. Upgrade from the garage, we don't mind it not being over 20-foot clear or, the industry standard 30-foot because we actually ended up climate controlling it. So it's a climate controlled 1,500 square foot. We're able to compress the price point per square foot because it was that way. And then, hopefully once we exit it, get a really good cap rate on it. And so those are the things that we like to look at. One, is it really functional? Access, egress is really important. I feel like I've matured as an investor because I really care about the parking lot. So it's like,
That's another
oh,
thing
the
from
most
Joel.
boring thing. Yeah, the most boring thing that you could care about is the parking lot. And so does it have enough parking? Is it fenced in? Is it well lit? I think it's really funny. I have a small team now, and we have a new grad here. He's like 22, 23 years old. And so I like to, and Chad, you've helped so many tenants and you've helped so many people. Have you ever heard a tenant be like, oh, you know what? The parking lot is just too big. I don't want to lease it. It's
Never.
always the opposite, right? Never. You've never heard that. It's always the opposite. Oh, it's a little bit too small. Or, Chad, have you ever heard, you know what? It's just too secure. The fence is too good. It's too well lit. Like, no, of course. And so, once again, we're really, even borrowing from BK, this is a blocking and tackling sport. And so you really need to know the fundamentals and the basics and do those really, really well. I remember, looking from my single family like residential days, like, oh, how do we get on top of the trends, like, oh, maybe we put granite here and then we do this really cool backsplash. Like, these tenants don't really care. They just need the fundamentals and the basics really, really done well, whether it be parking lot, security, access, and then of course the space and location.
Very well said. And yeah, that I remember, Joel, those are two nuggets that have stuck with me from the conversations that we've had is the geometry and the parking. And both of those aren't things that might come natural. Like you said, when you first started, that wasn't top of your mind. It was the ceiling heights and other attributes where that's we tend as investors to look at the building one way, but tenants are going to look at it a different way. They're going to look at it, are my employees going to have a place to park? Or is it going to be secure? Do I have to worry about theft? An investor isn't as concerned about the inventory inside the building as the tenant is, where that is their actual business. So I think that's very insightful to anyone that's considering investing in industrial is that yes, you need to look at the fundamentals of the building, but you also need to look at it from the tenant side because they're the ones that are ultimately paying it. And one thing that I've always said is that industrial real estate is a function of what the value of industrial real estate is a function of what a tenant is willing to pay for it. So just
Mhm.
basic income, capitalize it. There's your rough value. I hate using cap rates because it's so simple that it's misleading, but just as a real high level top 30,000 foot view of valuation. That's kind of how buildings get valued. So on that topic, how are you looking at properties? And you can talk about Tulsa's market specifically if there's opportunities like this, but are you going into it on a cap rate first? And then if that meets the smell test, you then start looking into an IRR return and cash on cash? Or how do you evaluate it from a financial perspective?
Yeah, so we take a lot of different considerations, but really for us, we are cash flow first. And so when I first started in investing, I was trying to hit my financial freedom number. I was trying to get cash flow. And so luckily here in Tulsa, it is, considered either a tertiary or secondary market. We're still able to get some really, really good deals. And since I'm a value add, that's all I know. We usually take a decent amount of risk up front, try to mitigate it, whether it be in construction or on the buy, or the financing or whatever, whatever lever that we can pull and go for that cash flow. And then, of course, since it's based on the NOI or the rental rate, we're in theory increasing the value of the property by getting a really strong tenant. And so, kind of going onto that aspect, we signed our first national tenant from the portfolio that we were talking about previously. So we had an interview. We talked in 2023. I was under contract for about 40,000 square feet. Learning the process of going through a credit tenant, a publicly traded one, how fast/slow they move, what's really important to them was really, really key for us. That one, we actually ended up signing Sunbelt Rentals to our portfolio on a 7-year deal. And we were able to understand just what was really important to them. And of course, we took a little less cash flow just because we knew that they were a solid tenant. They are a solid tenant. And so we really, really like that. But yeah, some of the financial metrics, really, if I was to rank them, cash flow first. Once again, we really do care about the building itself. So it really is the marriage between, okay, is this lease outable again? Let's say Sunbelt left. Did they improve it or did we upgrade it so much that it's not really usable for anybody else? Or, is this property so specialized that it can only take into account maybe two or three tenants? So we really do care about the building. And then we care about the exit. So we back into an IRR over 5 years, depending on that. But yeah, we're open to selling or refinancing. For the majority of my portfolio, we have refinanced most things out. So we haven't really sold. We've really only started to sell my single family portfolio just recently, just to get some more time freedom back to be able to re-put it into industrial.
Yeah, well, great insight on that too, by the way, because that's exactly how I look at properties. And the one thing that I've said so many times, people are probably sick of it, is that first thing you need to look at your downside risk. You need to identify your downside risk before you make any projections, because everything will change. When I was interviewing Sean Delphin a couple months ago, this one other thing that really stuck with me. She said your rents will change, your expenses will change, the market will change, your exit cap rate will change, everything will change. The only thing you can actually really control at the beginning is your basis. So looking at that downside risk first is imperative in my mind. When 2023 was the last time we talked. That was when interest rates started. They had spiked by that point. There's some softening on it right now, but it hasn't changed a whole lot. Have you been able to make deals pencil, or yeah, you obviously have, but have you had to look at a lot more based on getting it to actually make sense with the higher interest rate environment?
Yeah, definitely. So back in 2023, we had to do a lot of creativity. So that portfolio that we were under contract for when we last spoke, I actually had some of the owners contribute and do a seller carryback. So they took the portion of their proceeds and they gave us a loan in the second position. And so banks were not lending at that point. People were just worried, not knowing what was happening. Once again, the sharpest increase of interest rates had just happened historically. But I still really, really care and passionate about industrial real estate. And just for context, spoiler alert, we took the portfolio basically 100% vacant because the business owner that was selling it was moving out and he sold his business and now he sold his real estate. So we actually took over a fairly like 0% vacant occupancy rate. We are now 100% occupied. So that's just real estate and industrial real estate here in Tulsa. And it seems like for the United States too. But we had to be super creative taking over some of these properties. And once again, in the environment that we were doing, we were just kind of heeding to the bank. So the bank really wanted low LTV. So we were able to get that second position. Since then, in 2024, with the rates escalated, we ended up actually raising capital and then buying the next property. It was a smaller one, only about 13,000 square feet. That one we bought full cash, just because there was no crystal ball. No one knew what was happening. And so we said, hey, listen, let's just give ourselves a little bit of time. Obviously, our IRR and our financial metrics are going to be squashed, but I'd rather just know what's happening and not have to be a slave to the bank in this particular deal. The previous deal that we just did that we closed on, and this is June, I believe, 2025. We closed one in February 2025. That was like the most stressful financial acrobats that I had to do ever with a bank. We thought that the skies were kind of parting, people were a little bit more clear, and at that time, we knew what the election was, and so we closed on it in February. But I had to bend over backwards. I had to basically give my firstborn and sign away everything to get that financing done in 2025. So maybe it was the experience with the bank, the actual particular bank. Maybe it was just the financial kind of situation of the United States in general. But they have progressively gone harder to where, once again, we are considering the next purchase a full cash purchase just because we had to go through so many acrobats and hoops.
Yeah, what's that saying about banks? Banks will only lend you money when you can prove that you don't need it. So something to that extent. It's yeah, they could be your best friend or they can be your enemy. Maybe that's
Yeah.
too strong of a word, but yeah, they can be frustrating to deal with when things aren't ideal. But you can also help scale a portfolio by using them. So it's kind of a necessary evil, to use another aggressive term on it. What one thing that I think a lot of people would be surprised at is that industrial real estate, because there is such a wide spectrum of sizes, like the Boeing factory all the way down to a small 2,000 square foot bay. There's also a varying degrees of money sophistication. So you might have a smaller local investor, which I'd consider myself, all the way up to a Prologis, which is the world's largest industrial company, and they've got $100 billion market cap. Are you competing with, and Prologis, I'm guessing, is more in, if they are in Tulsa, I don't know if they are in Tulsa, but they'd probably be chasing the 500,000 and a million square foot bombers. But call it like a Hunt and Zach with TrueCore, where they are across the US. They're really aggressive. Do you find that you're competing with that more institutional or higher grade investor, or are you competing more against local investors like yourself?
Yeah, really, I am competing at the moment with local investors. It's a really interesting market share. And when I first started in industrial, one of my main thesis points was that there is not so much institutional money chasing it. And if it is, it's in a subset class that I'm not even competing in, whether it be the Amazons, the FedExes, the Walmarts, and the Boeings or whatever the case may be. It really is especially being very local here to Tulsa, I'm able to put a lot of strength and do a lot of value add, whether it be connecting with brokers or even finding the deals, some of them myself. But then also, I'm dealing with mom and pops or just regular people. So I'm not really dealing with these financial things. So I'm able to sit down with them and say, hey, listen, back in 2023 or 2024, hey, here's what's going on. Not a lot of people know what's going on. But if you did want to cash out or sell your business, or since he had sold his business, he did want to get out of the real estate, we were able to sit down with them and, negotiate a carry back and make a win-win. And it's actually funny, since then, that carry back, he has actually invested in some of our deals just because he likes industrial and he likes me. And so that's kind of the way that we do business. But yeah, the pool is interesting because there's another reason why I like, and once again, tying it to the second purchase that I made. They're owner occupants, so I wouldn't say I'm competing really against any institutions or even Hunt and Zach. Definitely sitting below them, but I'm probably more competing against owner occupants at this level and where I'm at when it comes to the size of deals.
Yeah, good point. So you're at 60 houses still and 200,000 square feet of industrial. The 60 houses has got to be management intensive compared to the 200,000 of industrial. How are you doing that?
Yeah.
In-house, external property management?
Yeah, so at our peak, we had an in-house property management. Now the project managers and the people, we're really kind of the operations is we're flipping out of these houses. So I tried a couple times to sell them as a portfolio, maybe chunk them out, dozen houses at a time. Really, the highest and best use of those are to, the owner occupant that can use a federally backed, FHA loan or, whatever, Fannie Freddie loan. And so we have started to flip those out. That's why it's taking a little bit of time. But yeah, we're selling about a dozen homes, one per month. And we are, putting in a decent amount of money into them and basically flipping them out of our portfolio. So yeah, we can talk about management because this is one of the reasons why I love industrial real estate is because there are triple net leases. Now there are things that happen within, small businesses that always is moving, but it is definitely less management intensive when it comes to that. And so yeah, we have currently like 5 flips going on at one time. Some of them are on the market. That's whichever what cycle. And once again, we're here in the summer, so we're trying to peak for this, but I have basically, if I was to break it down, 15% of my mind goes to the industrial portfolio, and then the rest is for the residential operations.
And is that a function of strategically trying to exit, or is that a function of the tenants are just more demanding?
Yeah, I would say the operations to flip it is definitely the brunt of it. But still, even if I was to break it down, these tenants, you have some great residential tenants. You try to treat them well. But yeah, just from a standpoint of modified gross versus triple net, and then once again, residential, this is another thing, not to get political, but even in Oklahoma, here in a landlord friendly state, there has just been more regulation and, this housing as a right has really just increased pretty sharp and dramatically. And I think if I was a betting man, that there's going to be more regulation about, housing, residential than there is in industrial or businesses. And so that's another trend that I see. And so that's why we are, exiting some of our single families and keeping the best ones. And that's not only houses, but also people too. And so once again, in my portfolio of 200,000 square feet, I have a couple larger tenants like Sunbelt Rentals where we don't hear from them at all. Maybe we get one letter at the end of the year saying that they paid taxes and that they renewed their insurance. So maybe that's two emails versus, 60 homes. That's, 60 different families, maybe 200 plus people, different things like that. So you can just imagine things that are happening.
Can you give me some examples? Like that's a big residential portfolio. So like what does a day look like in managing a portfolio of that size?
Yeah, so I kind of call it a monthly cycle. The majority, and just it's kind of shocking now that things and inflation and things are tight. It really is. We're setting up payment plans on a monthly basis. I would say that 50%, maybe it's a coin flip. Yeah, 50% of people pay before before the 5th of the month. We're usually setting up payment plans. For example, this just happened. There was a roommate situation where one wanted to move, the other one didn't, and they're both on the lease. And so we're trying to deal with emotions and different things along those lines. I'll even share this. I wanted to kind of talk about it a little bit. Like the regulation here when it comes to, I know there's a couple like warehouse moratoriums and stuff like that, but here in Tulsa, they're saying they want more housing. They said that they want 8,000 new units by 2030 or something along those lines, but they're not doing anything. And they actually put together a task force to reinspect multifamily homes, and they're flagging some of my friends. Luckily, I don't have like larger multifamilies. So my friends, and they're making them like hire an engineer to look at broken concrete in the yard and different things like that. So it just feels really ticky tacky, and luckily it's one of those things. So once again, we're dealing with a roommate situation right now. We have a move out because a person got divorced, and then we're being very gentle with them, releasing them out of their contract because of that. Unfortunately, one of my tenants lost their job, so we're kind of prorating and making a payment plan with them, different things like that. And so yeah, that's just a day in the life.
If you could go back and do it all over again, would you have that blend? Because it does offer some diversification. Like we're both industrial nerds, we both are bullish on it, and we're put a lot of our eggs in that basket. That diversification is helpful. Would you have a split of that again, or would you go straight into industrial?
Yeah, residential really has changed my life. Or real estate in general has changed my life. Luckily, here in Tulsa, the cost of living is really low. So I was able to get into real estate without having to do like fancy partnerships or like raising capital and different things like that on the single family side. I wish I kind of saw the scale and saw a lot of other things. I really tried to do it myself for way too long. But yeah, if I was to do it over again, I would probably just buy a couple single family homes. I still like that diversity. I still think, people want to live somewhere and not multifamily, for some people. And so, but definitely scale it back. So if I was to do everything over again, really blessed to be in this career path and to be able to kind of stumble my way through without having huge mistakes, especially, that first house that I bought, I couldn't sleep for like 4 days straight. And now, looking back on it, I was like, I should have just bought everything. And I'm sure people that were in industrial would have said the same thing too. So if I was to do it over again, I really still like single families. Like I said, we are going to 80-20 Pareto principle it all the way down until we just have the liquid gold of single families from our portfolio. We're never going to get that cost basis back again. For example, my first deal, I bought a single family home for $75,000. That's now worth 200 grand.
Hmm.
That's never ever going to happen again. But same thing could be said for warehouses. Even just a couple years ago, we were seeing things And now it's like, man, I wish I would have bought more warehouses because we're 100% occupied. Still looking for more deals. We're under construction for a very large tenant that was in this recent February purchase. So we're going to stabilize that, and then we're looking for the next one. So yeah.
Yeah, I've found that there's two types of industrial real estate investors. The first one is one that had exposure to the industry beforehand. So that could be an analyst that worked for a REIT, or it could be a broker, or it could be somebody that owned their own business and they had rented warehouse space and they had some familiarity with it. So that was just a natural segue because they'd already been exposed to it. And then the second is investors that start somewhere else. And it's usually a residential, whether it's maybe they scale it, they buy a few houses, then they buy multifamily, and then they say, well, I don't want to keep having to deal with all these residential hassles. So they start looking elsewhere, and then they stumble across industrial. It's really the only two paths that most investors that I've talked to have gone. And I think it's a really good thing to actually start in residential. I don't want to do it anymore. I'd owned some residential early, and I don't want to do it again, but I think it's a fantastic spot to get into real estate because you have to prove that you're a responsible operator. And sometimes industrial can be a little bit daunting. And if you don't have knowledge on it, you can make a lot of risks and a lot of mistakes. Whereas residential, you have to show that you're a good operator. You have to prove to the banks, you have to prove to investors, you have to prove that you can actually have asset management and that's not a term that probably gets applied to a house very often, but I think the principle is important. You have to be an asset manager, and that's taking everything, the property management element, the financing, the reporting, the maintenance, everything on it. So I think starting with that foundation is actually really important no matter what your end goal is. So kudos to you for doing that. What are you looking just in Tulsa, or at some point do you consider exploring the rest of Oklahoma? Do you look at Texas? Do you look at other markets around you? Or what is the long-term vision?
Yeah, yeah. So it's funny. I was listening to our interview back in 2023. I was like, yeah, in maybe 3 or 5 years, I'll be looking in OKC, Oklahoma City, or Northwest Arkansas. And no, I don't want to do that anymore. So I think I'm going to say another 3 or 5 years, we'll look at that. But right now, we're really satisfied with the Tulsa market and the deals that we're finding. And we're actually flirting with development, so a newer infill development here in Tulsa. And so that's either our path, whether we do just kind of doubling down in our backyard, just since we know all the players, the brokers, and they know us. It'll be good to do that. But yeah, we're looking for Class B, so existing infill, or we're going to build like an infill, flex style property. I think, yeah, maybe in 5 years. I keep saying 5 years, even like even though it was 2 years ago now. Maybe in 5 years we'll look at Oklahoma City and Northwest Arkansas. But right now we're pretty comfortable here. Don't have to drive, 2 hours to go see an asset. And yeah, I built out my team to where they're really, really hands-on. One of my team members, basically his KPI is like, how many times did you visit the properties? And, on a weekly basis. So we like that. We like our backyard, have intimate knowledge, and we can find some really good deals here. So just still digging our heels down.
I think it's a great strategy. How are you finding deals? Are you working with a lot of brokers? Are you trying to find off-market stuff?
Yeah, so off market is probably our bread and butter, but we are working with a lot of brokers too. And so we found it really, really valuable. They just have so much intimate knowledge and they're really, really good with people. So another tip is businesses that have sold. And so we, coming from my residential days, most of my stuff was done off market. And so it's funny. I was reflecting. We still have our Craigslist deal. The very first deal that I ever done was found on Craigslist, a 25,000 square foot industrial. Probably not the best way to sell something, but I browse those. I browse Facebook, and I'm connected with the CCIM, SIOR, and NAOP. And so, but yeah, some of it is referral based now. Some of it is cold calling at its best. But yeah, it's really interesting because some of the properties that we like, our average bay size is about 4,000 square feet, but usually there's 2 or 3 bays in there. So 8,000 to 12,000 is really our sweet spot. And some of our best deals are actually like 13,000 to 16,000 square feet. So all under 20,000 square feet. So not a lot of brokers are really, really trying to press forward in those and connecting with those. But that's where we can shine. So we do both, basically, to answer your question, brokers and off market.
Yeah, I love it. What advice would you have for an investor and just to perhaps put an avatar on it? Somebody that owns a few houses, maybe
Mhm.
just wants to diversify, maybe they just want to get away from residential, whatever their reason they're considering industrial. And the first thing that I would say is that be afraid, like I talked about before, be afraid first and foremost because mistakes are amplified. But if they have that in the top of their mind that okay, I got to be worried, I got to make sure I don't make a mistake. They're in that position. What advice would you have for that investor?
Yeah, yeah. For me, it once again depends on the personality type. When I first got exposed and wanted to get into the commercial side of things, I was initially thinking multifamily or like mobile home parks or something along those lines. And so there was some easy, ready content, bigger pockets, different things like that, and a lot of books that focused on multifamily. There aren't a lot of books about industrial, but that has now since changed because Chad has actually put out a book. Really, and I'm not getting paid to say this, but I really wish that this book was ready and available for me about 3 years ago when I first was getting into it. But there's some really great books, including Justin Smith's, and now Chad's, and then creating Trinity, all these things. So I'm a content guy first. Hey, get immersed into it, get knowing what's happening. Another thing that I would tell people is that it really depends on your personality type. For me, as you can tell, I like bigger moving parts. I'm a visionary. I like bigger deals. I don't really like ticky-tacky things. My single family, when I first bought them, they were cash flowing $100. Now, of course, now since I've owned them, they're cash flowing much, much better. But yeah, uh, my personality type suits industrial really, really well. But for me, I'm a content guy first, and then I like seeing is believing. So I like tracking all the data that comes in. What company is moving here to Tulsa? What are the things moving around in my market? So I like driving and just saying, oh, there's this company. Oh, there's this company. There's a company. It's really interesting. If you're not in industrial real estate, you really don't know what's going on in the industrial side of the world. There's a company that makes plastic wrap and it has like 500,000 square feet here in Tulsa. And I would never have known. And no one knows this, right? You can hear about the Amazons and the big manufacturing things, but there's just companies all over. So I track, I'm a data first guy. I'm a content first guy. So just get immersed into it. But for some actionable tips, here's what I'll say is go ahead and drive an industrial park, connect if your town or your city has CCIM or NAIOP meetings, go plug yourself into those, drive an industrial park, see what's moving, track the data, read some books. So those are my actionable items.
I love it. I couldn't agree more with you. You and I think very, very much alike on all these things. Driving industrial parks is the most underrated thing that someone can do because it's so easy. Go on a weekend. Most industrial parks are slow on a Saturday and Sunday, and industrial parks tend to be clustered together for good reason. So you can drive through an industrial park in 2 hours and get so much information and just get exposed to so many different ideas. Like that plastic wrap one, I came across one a couple of years ago, which I still tell this story of. It was a 5,000 square foot bay, and the company in there, all that they did was service old arcade games and pinball machines. And they must have had 50 in various states of repair or assembly. And I just remember thinking, yeah, of course there needs to be one of these businesses because these things are going to break down. Someone has to be able to
Yep.
fix it. They just figured out how to do it at scale. But that's something that you'd have no idea or even think about. But once you get exposed to industrial, I think that's one of the most exciting things about it is that it's the wheels of commerce. It's what keeps everything going, and I love it. It's so there's never a dull day. You're not walking through office space where an accountant looks exactly like a law firm or a real estate company. Every industrial building is different and has some unique element about it. So I absolutely love it. What's one question I've been trying to ask, and I don't think we asked this in our last interview, but I'm trying to ask every guest is what haven't I covered that I should have covered or that you want to bring up?
Yeah, I would say when I first started, I didn't believe triple net leases were real. I was just like, why would the tenant pay for the taxes, insurance, and the maintenance of a property? I would say that I was definitely a little gung ho. I was like, this is sliced bread. When you're dealing with local credit tenants, though, there is a lot of negotiation. You're still dealing with people. So, as much as if you have followed along my journey, I was like, hey, people are robots, businesses are robots. That's really not true in this case. You're still dealing with people, and especially with small businesses. Triple nets are really hard. You're trying to explain it, you're trying to educate it to them. So sometimes, as amazing as triple net leases are, there's some give and take and definitely some communication. And once again, if you think of a business, it is actually pretty heartbreaking. I have had to go through a couple evictions now. Used to do it a lot on single families. That's just a business. We have a lot of empathy, but even more so now that you've had to go through it with a business, this is someone's, startup. They've tried to make it work. And so there's a human behind the business. Now, when it comes to my Sunbelt rentals, nope, no human at all. That is just lawyers and they talk to each other, whatever the case may be. But when you're in kind of Class B or shallow bay or, light industrial, that's something that I would want to say. So the question, I kind of went on a rant. There really isn't a question that
Loved
I
it.
don't think
No,
you
I
you
love
you
that.
told me, but yeah, I think it's just really important to say that, hey, as much as I want to be a robot, and hey, here's what's on the paper. This is what you need to say. You sign this lease, you get, your CAM and triple net charges charged to you. There is that conversation, and it's not as robotic as I would like, and what people might like to.
I think that's such a brilliant point to make because you're right. And I hear this people say, oh, I want to get into industrial because it's not emotional, it's just business. And I think, well, there's a person behind that business, right? And there's a
Mhm.
person behind the ownership of the property. It's probably in an LLC or a company. It might be in Delaware. So you might think this is so far removed, but there's a person behind it. There's a person behind that owns the building. There's a person behind the entrepreneur that wanted to start that business. And unless you are at that scale of the ultra large companies where it is purely business, there is a person behind it. So you're right. If you're running a small business and you're on a triple net lease and you get hit with a reconciliation at the end of the year because property taxes went up and there was some freak event that had to be put into the operating costs, and you get hit with a massive invoice that you weren't expecting, that can be devastating. So that is a tremendous point to add, is that yes, it's triple net in theory, but you still need to be very delicate with how you're handling that. And hopefully you don't have many of those scenarios, and hopefully companies are just prepared for it and they can brace for it. But yeah, you want to be very sensitive to the fact that yes, this is business, but there's still people behind it. Fantastic. Very well said. I appreciate you bringing that up. I would recommend everybody follow you on LinkedIn. You took a little bit of a hiatus, I believe. You weren't on
Yes.
a whole lot for a while, but you have been posting more. I think you put out some absolutely tremendous content. So I'm going to recommend people reach out. I'll put your LinkedIn in the show notes. Any comments on that, by the way, on why?
Yeah. So I hit it pretty hard, and I was just so gung ho about industrial real estate. But then I had my third son. So I have
Congrats.
three boys now. And
Congrats.
so that's why I took a break on LinkedIn too. So I am going to start to work the engine again. We have some really, really cool projects. We didn't really get to talk about it. I have the whole story of Sunbelt Rentals. Once again, that was my first time working with a publicly traded company wanting our space. Spoiler alert, it took about 9 months just to negotiate like the lease. I know Chad is probably, he's like, oh, that's pretty short actually. I'm sure you've had some horror stories of just, companies taking so long. But for me, I'm used to a residential where it's like, see the property, you apply, you get the keys. And so, yeah, I have so many stories that I like to reawaken. That was actually done in 2023 and 2024. And now since then, we bought another 50,000 square feet, and we're learning things all the time. So we just bought a property with a billboard that's close to a highway. We just did a parking lot remodel. Once again, we're like super boring. We're like, yeah, we love parking lots, and so, but asphalt cost a lot of money, and once again, so I have a lot of stories to share. Please follow me and connect with me too. Once again, I can't shut up about investment, business, and industrial real estate. And yeah, once again, just another shameless plug for Chad's book. It is really, really good, and it's really comprehensive. And once again, I wish I had it, when I was first starting, or even just learning about the asset class.
I swear that I'm not paying Darren to say that.
He is not. He is not.
Thank you kindly for those words. I really do appreciate it. And it's a mutual respect. I've got a tremendous amount of respect for what you're doing and big fan. We need to do another episode actually to do a deeper dive because we could talk about dealing with a large corporate tenant, your 50,000. If you go forward with that construction plan, that's another interesting thing we could do a deep dive into. So let's keep that on the list and in the fall, try to do another episode as well.
Yeah, I'll come up for air because we actually haven't told that many people, but we signed another very large company. It's called Terracon Consultants. They do engineering work and environmental. And so this is like the whole shebang. I think we have about $500,000 of TIs, and so it's really really cool. And we're redoing the parking lot and all this other stuff. So I'm learning and I'm trying to make it work, and I'm hustling out here. And then once again, the goal is maybe an infill development too. So that'll be another thing that I learn. So yeah, I'm excited to share that, and I'll get back on my content posting. So it'll be fun.
Love it. Follow Darren on LinkedIn and stay tuned for another episode, hopefully in the fall. So, Darren, thank you so much. I enjoy every time we get to chat.